What do you consider is a more recession-proof real estate investment?
People are always going to need a home to live in. If you're going to focus on any asset type and you want the most recession-proof asset type, I would say
companies like Capital Fund funding those deals, individual investors out there taking a risk and going and working hard, private money lenders, a lot of you with your IRAs, that are then coming in to fund making these deals happen, that are turning over these properties that are a train wreck in our communities that get turned around into a property that provides housing and opportunity, jobs, all this thing. It's an awesome thing. Welcome everyone to the Directed IRA webinar and a special Directed IRA podcast episode. This is Matt Sorensen. Thanks for being with us. We're talking about real estate opportunities in today's market. Many of you know there's more millionaires made in real estate than anything else. It's the number one asset out there that people are interested in because real estate, it's not going anywhere. And but you don't want to hear about me on this. I'm intermediate at best in real estate investing and where there's opportunities. So I have Noah Brocious here with us. Noah is the president of Capital Fund. Okay. All right. The president of Capital Fund. I was looking over you like you're Joe Biden, like you're the president. Yes. Sorry.
I think so. Yes.
Sorry. No political jokes. I'll refrain from those. Okay. So I'm going to give a little bit of intro and I'm going to let Noah explain to us where he's seeing opportunities right now. The reason I have Noah here is Capital Fund is very well known here, particularly in the Arizona market. And if you're a real estate investor or someone doing real estate deals, like you know who these guys are. They're kind of a big deal. They've got $925 million lent out right now. And you're not lending to people like individuals, right? You're lending to investors.
Exactly. Yep.
So why don't you tell us a little bit what Capital Fund does, kind of your footprint maybe a little bit, and then I'm going to just dive into questions, sir.
Perfect. Well, yeah, thanks. First of all, thank you for having me here today, Matt. Really appreciate it. So Capital Fund 1 is asset-based private or hard money lender. We lend money to real estate investors, builders, and developers for real estate projects. We make short-term loans. So we write anywhere between a 6 and a 24-month loan. And we're currently lending in Arizona, Colorado, Texas, Tennessee, and Georgia.
Okay. All right. So now you guys have a whole team. Obviously, like you have some of your own capital. You have investors that invest in the fund.
Yep.
But then you're using that money and lending out to other investors. And I think that's why I really wanted Noah here today is because you're seeing like what are people doing in the market? Like they're coming to you with deals, and your team is like analyzing the deal and saying, "Do we want to lend on this?"
Yeah.
So why don't you start with what you're seeing out there in general in the market? We can get any examples you want to do, but what are you seeing out there right now?
Yeah, I mean, it's, whether the market's good or bad or balanced, there's always opportunities in the real estate market. So, a lot of people recently that I've talked to have said, oh, man, you can't be getting any deal flow because the market's not good.
Yeah.
But that's quite to the contrary. Over the past 3 months, we've averaged about 850 or 900 loan requests a month.
Yeah.
So we're seeing a lot of deals. We do a lot of single-family residential fix and flip loans. We also lend on multifamily. We lend on other commercial assets like industrial, retail, hospitality, mini storage, and office. We make ground-up construction loans, primarily residential, but we also do some commercial construction loans, and then we also lend on land.
Okay.
So we're really seeing our borrowers be resourceful and find good deals in all those asset or loan types.
Okay. If like what are some of the characteristics of deals? Maybe just help someone because like we have a lot of people on here who are investors themselves. And some super experienced and they got their deal flow. Some maybe a little bit newer, might be looking for opportunities. Where do I invest? My IRA even, or my other non-retirement account dollars. They love real estate. That's the number one asset people buy here.
Yep.
Like, what do you see people doing? Like, what are like maybe a strategy within some of those different asset categories?
Yeah, I mean, like I mentioned, we do a lot of residential fix and flip loans.
Yeah.
So that's the majority of the deals that we see. And the majority of the opportunities that our borrowers.
So what makes it a good deal for you guys where you're going to lend? Like if I'm like, let's say Aaron over here has got a fix and flip deal. I've got a fix and flip deal. What makes it my deal one you're going to lend on and his deal one you're not?
Yeah. So typically,
because usually that's an indication that I've got a good deal and he doesn't.
Exactly. Yeah, absolutely. So, yeah. So what we want to see is typically a borrower is being able to buy the property, at or ideally below current market value.
Okay.
And they can, they can use our money similar to how somebody else would use cash because we can close quickly. So we can, when we started back in 2009, we were just lending on properties purchased at the trustee sale.
Okay.
So we really cut our teeth on 24-hour funding. So, there's not as many properties going to foreclosure. We're not doing as many of those, but
That ain't 2009. That's definitely not that market.
no. But there are still deals that we'll get where the borrower needs to close in a day or two.
Yeah.
And we can close that quickly.
Yeah.
So a lot of times our borrowers, for example, say there's a house in 3-bed, 2-bath, 1,800 square foot house in Glendale.
Yeah.
That's, not move-in ready, so needs to be rehabbed, and maybe it's listed for $400,000.
Yeah.
One of our borrowers can go to that seller and make an offer and say, hey, I'll waive appraisal contingencies because we don't require appraisals. They can waive inspection contingencies, and they can close in 3 to 5 days. But a lot of times that borrower that brings the deal to us will go to that seller and say, hey, I can waive all these things, I can close quickly, but instead of the $400,000 list price, I can pay you $350,000 because it's a quick, clean deal. So a lot of times our borrowers can leverage the fact that we can move quickly to buy under market value.
Okay.
And then we also, want to make sure that there's, meat on the bone or there's value to add so that the borrower should be able to make a profit on the deal.
Okay. So, you guys have your analysis on it. First starts, it needs to be below market value. You guys, because the loans are short term, you don't really care what it can rent for, stuff like that. You're really in it just from a value standpoint because you want to make sure you get paid back, obviously. And their intent, you say 6 to 24 months is the term of the loans. Mm-hmm. Okay, so and I think there's lots of acquisition strategies, of course, on how people are buying properties and finding opportunities, getting people who have, properties they can get below market. Yep. And many times it is simple enough as, like you said, is like it's a timing issue. It's an issue of it's just no one's going to buy it and be able to move into it immediately. Right. Anyone who buys it's going to be like, this is a 6-month project or a 3-month project or whatever it is before I can even move into it. Yep. And if for most home buyers, right, they're like, well, I got to sell my house to buy this house. Am I going to go rent somewhere for 6 months while we go fix this thing up? And
exactly.
And I think that's a big opportunity for the investor, and because there's a lot of people in that scenario. What about on the commercial side? You guys are lending on like multifamily stuff and commercial stuff.
Yeah. So typically,
what makes a good deal there? It could be similar analysis, but like.
Yeah, so typically a multifamily deal that we'll fund is typically a smaller Class C value add deal. Okay. So maybe think of again going to Glendale, a 40-unit apartment complex.
What's good Glendale? Is all the deals in Glendale?
I don't know.
If you don't live in Arizona, Glendale's. It's where the Cardinals Stadium is.
It is.
There's some nice places
Grand
out
Canyon
there.
University.
Yes.
Are they in Glendale?
Yeah.
Oh, okay.
Yeah. Oh, yeah.
All right.
Yeah,
okay.
No, bring your mic up a little bit. You have that deep, sultry voice.
we got a lot of good things happening in Glendale.
Okay. All right. So we got the Class C apartment in, let's say, Glendale.
Yeah. So typically it's going to be maybe an owner that's owned the thing for 20 years, hasn't really made any improvements to the property. Yeah. Maybe the rents are below market rate because of the fact that the property's not in great condition. Yeah. So our borrower will go in, they'll buy the property. As rents roll, they'll go in, fix up the units,
And it's so bad, the typical bank they go to is like, I don't know that. Class C in Glendale?
Right. No. Yep. Yeah. Well, yeah. And a lot of times, the bank won't lend on it. Yeah. And a lot of times, I guess kind of digressing a little bit, people borrow money from us for one of 3 reasons. The main reason is typically time. Yeah. So, like that fix and flip deal, a bank or a conventional lender can't move that quickly. Yeah. Same thing with on a multifamily deal, going back to the fact that our borrowers can leverage our speed to negotiate a little bit of a better deal. So maybe, they can negotiate a better deal by closing in a week or two.
Yeah.
So they come to us. So the first reason is speed. The second reason is, like I mentioned, we are an asset-based lender, which means we focus our underwriting on the property or the project, not on the borrower.
Yeah.
So we don't check credit. We don't need tax returns. We don't need bank statements. So think of everything you have to give a bank or a traditional lender. We don't need any of that.
Yeah. Okay.
So if a borrower has a credit issue, we'll still lend to them. I don't care if somebody has a 500 credit score or an 800 credit score. If it's a good deal, we'll lend on it. And then the last reason, a lot of times more on the commercial side or construction side, is that the borrower just doesn't want to deal with the brain damage of working with a bank or a traditional lender, especially in this higher interest rate environment.
Yeah.
Because there's not as much of a spread between what a bank will lend you money at versus what we'll lend you money at.
Yeah.
So, we funded a construction loan a little while back. It was a construction loan for a hangar project in the Scottsdale Air Park. So the borrower got a term sheet from the bank. The interest rate was 9%, and the bank wanted him to deposit either $4 or $5 million in the bank.
Yeah.
And on that deal, our interest rate's 12%, and we're not going to ask for any deposits, obviously.
Yeah.
So when you factor in the opportunity cost, I'm putting that dead money in the bank, along with their rate being pretty close to ours, and the fact that it's going to take maybe 5 hours to get a loan approved with us versus 25 or 50 hours with a bank.
Yeah.
If anybody puts any value on their time, our money is arguably the same cost or maybe even less expensive.
Okay.
So going back to that multifamily deal, it's something they're going to go in. They're going to add some value to the exterior of the property, make it a little bit more inviting for tenants. They're going to fix up any vacant units or units as leases come due. They're going to put new tenants in there. They're going to increase the rents, which increase the value of the property. And then they're either going to sell that property to another investor that wants the cash flow, or they're going to go to a longer term, more traditional lender and refinance us out and hold that asset.
And that's what I've seen with some other operators that have actually used you guys before on just kind of that Class C type, smaller multifamily deal where the quote unquote agency debt, like the Fannie Freddie's like, that's got to have 90% occupancy. Right. We're not lending on it. And they're like, the whole reason I'm getting a bargain on this is it's like 50% occupancy or whatever.
Exactly.
And, it's a 12 unit or whatever, and there's 6 that are just like vacant. And so like, I can't go get agency debt to buy it.
Right.
But the fact that seller's distressed means I can get a buying opportunity. But no lender's going to finance it. So then they kind of improve the property, get it leased, and then have your guys' debt, let's say, and then move to the quote-unquote agency Fannie Freddie debt.
Yeah, and one of the biggest things on those is they're going to look at debt service coverage ratio. So if there's high vacancies or rents are way below market, they're not going to be able to qualify for that agency debt because the DSCR isn't 1.1, 1.2 to 1.
Can you explain that a little bit more for people listening in, what DSCR is?
Yeah, exactly. So debt service coverage ratio is basically the revenue that you're receiving divided by the cost of your debt. So if you're getting $10,000 a month in rent and your debt cost is $10,000, it's going to be a 1-to-1 DSCR, debt service coverage ratio.
Okay. What is the typical, like, let's say, institutional, like a bank type lender looking for in a DSCR loan?
They typically want to see at least 1.1 to 1.25 debt service coverage ratio. So, I mean, we'll fund a deal if the DSCR is 0.5 to 1. Because we know that they're going to go in, add value, increase the rents, and then get to a point.
And you're lending back on the asset anyways. What's the value of the asset compared to what we're lending on?
Yep, exactly.
Okay. Yeah. All right. Questions?
Let's hit a few questions. These should be easy ones. So what are the current interest rates on construction loans, and how does it differ from a fix and flip loan?
Yeah, so rates are pretty similar. We're going to be in the plus or minus 12% range. The payments are interest only. And then a fix and flip is going to be, 11.5%.
And what are your down payment percentage requirements? Let's do SFRs versus like multifamily or commercial.
Yeah. So we're not like an FHA loan. It's not 3.5% down, standard down payment. So the down payment is really dependent upon the quality of the deal. So the more we like the deal, the better buy the buyer's making, the more meat on the bone, more value in the deal will require a lower down payment. So
but could there be like no down payment, like that example you gave? If you're saying this is an asset-based loan, and that value of that property is $400K, but you have got under contract at $280, let's say, and we've budgeted this much in repair value or like repair costs. I mean,
yeah, no, we all saw what happened in 08,
you want some skin in the game.
08, 09 when everybody got 100% financing. There's devaluation.
Yeah.
Everybody's throwing the keys back to the lender. So we always do require a down payment as little as 10%. On average, our down payment across the portfolio is about 20%. But on an SFR deal, it's typically in the 10 to 20, maybe 25% range.
Awesome. So could you explain like exactly what is LTV, loan to value, for people listening or watching, and what is typically the loan to value that you see on single family specifically?
Yep. Yeah, so we look at loan to current value and then loan to future value. So loan to current value is obviously, what our loan amount is based on the current value of the existing property in its current condition. And then our loan to future value is our projected value of that property once the borrower goes in, completes the rehab, and the property's ready to list. Yeah. So on single family residential, we'll lend up to 85% of loan to current value and up to 75% of loan to future or as completed value.
That's great. It's very competitive.
Yeah.
I don't know how much details you want to go into this, but a few people have asked, like, when you're taking on investors, what ends up being your typical downstream, like, net to the investor that they're seeing over, let's say, maybe a 12-month period?
Yeah. So yeah, obviously, like you mentioned, we've raised capital from private high net worth individuals.
Yeah.
We use that capital as well as some credit facilities that we use to leverage the fund to lend out to our borrowers. And returns vary, but typically, and most debt funds are similar. They're going to be in that 9 to 10% range as a net return to the investor.
Yeah, and so I think and you guys do have other investors. I know you guys have a private placement type fund, so it's not like you guys go out and solicit. Now, that's not what this is for, but but you do have a fund model. So we have IRAs invested in capital fund, and there's a number of different ways we've intersected over the years too. So if people are interested in that, you can get in touch with Capital Fund. But I think we have a lot of investors on the side of this that are like, well, I'm doing deals, and how do I access Capital Fund in terms of a capital provider for me too? Mm-hmm. And so we've been hearing those questions, but here's one area I've seen this combo of people's IRAs too, is we see Capital Fund, and I've seen you guys a lot in terms of like the acquisition. You're the lender coming in a lot of times on the acquisition, but then they're like, this deal needs another $100K to repair. And you guys are like, well, we've lent what we're going to lend. And they might have, the investor might have some of their own money in it, but then they go out and get other investors, private money lenders essentially, whose IRAs are lending maybe in second position to then go fund the rehab costs. And so that's another strategy in terms of what's going on in any of these markets. I know, we've talked about Arizona and Glendale here, but, but is sometimes you'll see a lot of more institutional hard money, private money lenders like you guys that are funding the acquisition, but it's an individual investor coming in funding that rehab cost. And so that's where I've seen a lot of the IRAs come individually, like in a second position, where you probably can get a better rate. Like they might be charging, what did you guys say, 11.5% is what you're charging. You might be able to get 12%, and maybe a couple points too, because you're in second, you're funding the rehab cost. One of the things that's nice, you want to be careful you get the numbers, is if you see like someone like a Capital Fund that underwrote the deal and did the first deal, at least they probably did a good analysis on the front end of the job, right? I mean, you got to do your own due diligence in terms of the IRA investor funding that second piece though. But I kind of love this topic because when we talk about the real estate market and all the properties in our communities, I mean, we're here in the Phoenix market. I'm just telling you, like, it is companies like Capital Fund funding those deals, individual investors out there taking a risk and going and working hard, private money lenders, a lot of you with your IRAs, that are then coming in to fund and making these deals happen, that are turning over these properties that are a train wreck in our communities, that get turned around into a property that provides housing and opportunity, jobs, all this thing. It's an awesome thing. It's not the banks. The banks aren't lending on these deals. They're like, do you want to buy a new house or a house that's in perfect condition? And so it's kind of like, it's good for the country.
Yeah, it is. It is one of the things I love about our business. I mean, obviously we're a for-profit business. We want to pay our investors a return, and we want to make a profit. But it is cool to see, some of these houses that are just in terrible shape, and what our borrowers are able to do to create, a turnkey move-in ready property for a family to move into. And like we talked about earlier, back, maybe 10, 20 years ago, there were people that wanted to buy a fixer-upper, and they'd fix it up themselves. But, not that that's completely gone, but for the most part, people want to buy a turnkey move-in ready property, and typically they want to live in an infill location. And, as we all know, most of the new home building is occurring on the outskirts. Mm-hmm. So if somebody wants a, quote-unquote new home, that's the type of home they're going to buy. They're going to buy a house that we've lent money to one of our borrowers. They've done a great job to rehab that property, and it's a great home for their family. Yeah.
Awesome. You got any questions right there?
Yeah, I do. Okay. This one's interesting, actually. I debated whether or not to even ask it, but
let's do it.
It's, and you'll see why here in a minute. Why don't you share your experience on, I'd probably come at it maybe from an underwriting perspective, especially because a lot of people think we're in a bit of a bubble too again. So the question is, what do you consider is a more recession-proof real estate investment?
A more recession-proof real estate investment. I mean, people are always going to need a home to live in. So if you're going to focus on any asset type and you want the most, recession-proof asset type, I would say single-family residential. I think, it's good and bad, but everybody still has, 08, 09 in the back of their heads. But, it was the absolute imperfect storm of, anybody with a pulse being able to get a loan. I mean, I remember getting a stated loan. And I was working with the mortgage guy. He's like, how much do you make? I was like, I don't know, how much do I need to make? Like, write this down. I was like, okay. And I was, my early 20s. I didn't know any better. So you had, Wall Street, absolutely, pushing money out to people that probably shouldn't have been borrowing money. You had way less governors on new homes. So, municipalities were easier to deal with. So builders could get permits more quickly. This was before SB 1070, so there was a lot deeper labor market. Mm-hmm. You didn't have supply chain issues. So you think back, I think it was 2006, there were 50,000 new homes built. And I think since then, the most new homes we built is maybe 26,000. So there was a lot of supply out there. The money was flowing, and then all of a sudden, the money stopped. So that was kind of the imperfect storm to create, all the devaluation. You read a lot of articles that say real estate's going to crash. And when people say that to me, I say, great, how? Explain it to me. And they say, well, no, it's just going to crash. And it's like, well, no, but you have to explain to me because it's all about supply and demand. So even with mortgage rates higher and the market being a little slower, supply's still low, partly because of the golden handcuffs effect of anybody with a 3.5% mortgage who's going to sell that house and trade into a 7% mortgage unless they absolutely have to. So supply's low, all the governors that I mentioned, municipalities being difficult, supply chain issues, labor issues, not to mention, the water issue. I don't know how big of an issue it is, but builders that are trying to build on the outskirts are having a tougher time building because they have to have a water solution. So I don't see a crash coming other than, some type of black swan event.
Yeah.
But, you can't waste your time worrying about things you can't control.
Yeah, and I think residential, single family, I mean, that is I just agree with that. That's just like, people do need a place to live. And that's why also multifamily seems strong. I mean, the one that's been obviously the most affected, and you have seen the actual foreclosures on a higher level would be like commercial office, right?
Yep.
And that's been a change in just kind of how businesses operate and the work from home movement, which I think will swing back over time. But there's been a shift there that commercial office I don't think was ready for.
Yeah, no, it was an effect of COVID and work from home and businesses having a tough time, requiring employees to get back into the office. So yeah.
So you're currently Arizona, Colorado, Texas, Tennessee, Georgia?
Yep.
Okay. Can you explain to everyone why you're in those states?
Yep.
And then do you plan on expanding beyond that and what it would take for you to do that?
Yeah. Yeah. So the first thing we look at is it has to be a lender-friendly market. So there's trustee sale states or deed of trust states and mortgage states or judicial foreclosure states. Yeah. So all the states that we're in are non-judicial foreclosure states. So, if a borrower doesn't pay or goes into default, it's a fairly quick and cost-effective process to foreclose on that property versus, states like Illinois, New York, that are judicial foreclosure states, Florida as well, where you have to hire an attorney, you have to sue the borrower, you
go to court.
Yeah. and anybody that's ever been
pricey.
It can be $10, $20, $50, $100, $200,000, and it can take, a year or two.
Yeah.
So that's the main thing. It's got to be a non-judicial state. Then it also has to be a growth market, a place that people are moving to. Mm-hmm. They have good economies, a good job market, low unemployment. So, and as far as additional states, I mean, there's some other states that we have on our radar. For now, in this higher interest rate environment, we're going to focus on the markets that we're in. But the next state, if and when we open another state, would probably be North Carolina.
Makes sense.
Yeah.
Which is where we did one of our self-directed IRA summits.
Yeah, we got a little contingency out there in Raleigh. That was a great event. Well, let me come back on that judicial versus non-judicial foreclosure, because I think as a private money lender, and many of you here that might lend your IRA onto other people on deals, that's a really important distinction, is those deed of trust or non-judicial foreclosure states mean you're putting a lien on the property and there's a trustee on it that can then execute on it if the borrower doesn't pay, versus a mortgage, which is judicial foreclosure states, which does require a court action. There's a complaint filed in court, and then it's a lengthier, costly process. What's actually funny, and I don't know if I've shared this, is that, so I actually did trustee sales for a brief moment. Okay. So when I was a lawyer in Utah, this was actually after the crash. I think this was like probably 2010. There was a bank that just, because I was in this smaller town, that just couldn't get anyone down to the courthouse in this area. Because even with the trustee sale, there's still like a little auction, and we'd go to the courthouse. And so I remember I was doing one, and so I was like doing this little trustee sale, and you got to like kind of go over what's being sold, you know? Mm-hmm. Yep. And so I'm calling it out, and think of it like it's kind of like an auction format, but not really. And the guy there that owned the house, that's getting foreclosed on, mm-hmm. of course, wants to bid, right? But I have a minimum bid from the bank, which is what is owed. Mm-hmm. Okay. This guy's there. He's like, $1. Because no one else was there.
Doesn't work that way, buddy.
I was like, bro, this is not the price is right. I'm like, $1. I'm like, the minimum bid is X. I'm like, you know what you owe, bro. Like, and so, anyways, it was funny.
Can you give us a trial run of how you called the auction? How you called the trust sale?
What do you want to give?
They don't do it that way. They really should. It should be like,
it should be fun.
Auctioneers. It's kind of like a little gaggle of people get together and they're like, all right. Anyways, I know some people do it differently. I've seen some of them in other states where they actually go to the property address and do it like at the property address.
Oh, wow.
Like that's what they do a lot in the East Coast. Yeah, like here in the West.
It's pretty brutal. It's awkward. It's awkward.
Yeah.
The kids are looking out the window. Why are all the people on the front lawn?
It's not cool.
Yeah. And you sleep on, anyways. So, but the, so the deed of trust states you do that auction and then no one goes to court. You're just standing outside the courthouse steps, so to speak. And then you file the stuff that said we did it and here's who's acquiring the property.
Yep.
So, okay. Well, that was a little
was good.
little story time there.
Yeah. Did you, is Capital Fund funding auction properties or bank foreclosed properties, REOs?
Yeah.
Okay.
Yeah, we'll lend on anything. People are buying properties off the MLS. People are buying properties from wholesalers. People are going, direct to seller on off-market deals. We still probably do one or two trustee sale loans a month.
Yeah.
So.
And I think that's a good tip too, because we've done a lot of content with Pace Morby. I was at his house the other day, and he's a big in the creative real estate financing. And one of the things they're always talking about, and Jamil Damji, I think I've seen you've known him. We worked together too. It's like they teach a lot of people how to kind of be a wholesaler first. Sometimes it's like you're brand new to real estate, you don't know anything, and you don't have any money, and but you're like, how can I make money today? Well, go be a wholesaler. Go find deals. And wholesale them to someone that wants to take it down, whether they want to hold it or they're going to flip it. And so that's a good strategy, is go find those wholesalers, and they might be ones wanting to find, they'll bring you deals. If you're like, well, I got the capacity to go take it down, and then I'll go do the flip, get the contractors, go work with a capital fund to fund the deal. Any other tips for people that are kind of entry level tips on how to do it? I think that'd be one, is there are wholesalers out there. Now they get a little cut, right? They're going to make a little fee on that. And it might be thousands. It's not typically tens of thousands unless these are really great deals. But they kind of get paid on the deal when you close on it.
Yeah. I mean, it's a great way to find deals, because the wholesalers, Jamil and Pace have done a great job of educating a lot of people here, locally and in other states as well. And there's people out there going direct to seller, finding people in, situations, death, divorce, things like that, where people just see that asset as a problem and they want to sell it. So that wholesaler will write a contract, tie it up, and then they'll typically assign that to the investor, whoever wants to buy that. And like you said, they'll charge a $5,000, $10,000, maybe $15,000 fee if they're getting a really good deal. So you're going to lose a little bit of your margin, but if there's still margin in it, and you didn't have to go out and knock on doors or find those people, it's a great way to find opportunities.
Okay.
I have a good self-directed IRA question for doing deals. So Jennifer asked, can you use money in your self-directed IRA account for a down payment on a property and get a loan?
Absolutely. Yeah. So you could use the IRA, and I don't know if you guys have done this, but let's say you have an IRA that it's gonna buy the property. It's gonna go get rehabbed and flipped even. Whether you're doing an IRA LLC or not. Since you're not checking credit, you're not running their stuff. You don't care, right?
And typically we have personal guarantees on our loans. We've done over 15,000 loans since 2009. I think we've gone after 2 guarantees. But when we're lending to a self-directed IRA, obviously that
you make an exception on that.
We got to take that guarantee out of there. So we'll do that. So yeah, and we do have a good amount of borrowers that use their self-directed IRA to buy the property. We lend money to the self-directed IRA, and they use that money as the down payment.
Okay. Cool. Great question, Jennifer.
These are for Noah. These are probably just quick questions, and let's explain them too. So Steve's asking, do you charge points? So let's explain what that means. Do you charge points on your loans in addition to the interest? And then the follow-up to that is, are you only doing short-term loans? Is 24 months like the max, or what is the max?
Yeah, so yes, we do charge points or origination fees. Typically on a fix and flip deal, we're going to charge 1 point origination, or 1% of the loan amount. On the other asset types, we might charge a higher fee, or on a longer term, maybe 2 or 3 points. And then, sorry, what was the second part of the question?
Are you only doing short-term loans, and what is the max?
Yep. So for us, the loans that we balance sheet, they are short-term loans, but we do have DSCR loans that we can put borrowers into. So a lot of times our borrower will buy a property with the intention of holding it as a rental. So they'll use our hard money to close, fix up the property, put a renter in there, and then they'll come to us, and then we can put a 30-year, typically fully amortizing debt service coverage ratio loan, which just means that the loan is qualified off of that debt service coverage ratio. So they're going to look at the rents that the property generates versus what the payment's going to be, and that typically dictates the loan amount. So we can do those 30-year notes as well.
So explain your business to me. So you have because I was even on the website. So you got Capital Fund 2, which is more where investors are going to invest in your fund.
Yep.
And we're not like solicitation or anything, but I'm just trying to understand your business. And
Yeah.
then if I'm a real estate investor and I'm like, all right, I want to get a loan from Capital Fund, and that would be the Capital Fund site you were citing, the Capital Fund one.com.
Yeah, Capital Fund One. That's the operating company. All of our employees are employees of Capital Fund One.
Okay.
In Arizona, we have a mortgage banking license that's held by Capital Fund One.
And that's got like the application and the terms and all that for a lot of the loan products. There.
Capital Fund and the number one.com, and then the other one's Capital Fund and the number 2.com, correct?
Mm-hmm. Yeah.
All right. Any other questions we got?
Yes. So what happens if you do a private money loan and the person borrowing passes away?
Somebody that person knows either steps in and services the debt, or they don't, and you have to foreclose.
Like the estate would take over, like surviving spouse first, typically, or their heirs hopefully would take over.
Yeah. But it doesn't. You don't have to not foreclose, or you still there's still an agreement in place. Payments have to be made. If they are, great. If they're not, then you have to enforce your documents and go towards foreclosure.
Do you have any liquidity provisions for the investors going in there?
For the borrowers, no, we don't. A lot of, when we started back in 2009, there really wasn't much money out there to borrow. There weren't many private or hard money lenders. As the market got better, especially once Wall Street, started noticing our industry and like the type of returns that we gave, a lot more capital flowed into our space. Mm-hmm. So a lot of the groups we compete with, especially if they're selling their loans to aggregators that are creating securitizations or things like that, a lot of times they do require a credit check, they'll require an appraisal, and there is a liquidity requirement. But
you guys hold your loans, and so
yeah, okay. Not important to us.
It's interesting. I was listening to Howard Marks. You know him? Mm-hmm. Okay, so he's like Oak Street Capital. I read his memos and listen to a lot of his stuff. It's super interesting on investing. He was giving a quote that he said, the worst of loans are made in the best of times. Would you agree with that?
Oh, yeah. Yeah, I mean, some of the loans that we're still kind of working through, or loans that we had problems with, were originated in first or second quarter of 2022, kind of right before rates really started to go up. So yeah, I would agree. And especially, on land or commercial properties, as rates went up and as cap rates increased, a lot of those properties' values dropped. So yeah, I would agree with that statement.
Yeah. All right. So a couple tips I took away from it. One was on, because I'm just thinking of this from a lender perspective, just because you guys have had the perspective of lending out $925 million. Mm-hmm. But if I'm lending my own IRA, I'm thinking you like skin in the game.
Yep.
You're like, that's important. Even if it's a really good deal, you still want skin in the game.
Yep.
What else is a good tip for someone else that's lending their own money, similar to you guys? I mean, you're lending it obviously in a much larger amount, but what else is important for someone like trying to lend their own money on deals?
Yeah, like you said, you got to do some level of due diligence. I mean, if you're a real estate expert and you can value the real estate, obviously do that. If it's a friend that wants to borrow money, and you're not a real estate expert, I would suggest getting a real estate expert involved to be able to help value that property, to make sure that that you're making a good loan and there's equity in that loan, so that if the borrower doesn't pay and you have to foreclose, that property will either sell at trustee sale, or if you get it back and it doesn't sell, you'll be able to sell it and recoup your capital.
Okay. I mean, the bank calls that, underwriting, right?
Yep.
I mean, you guys are underwriting the deals essentially as they come through, and you have a team that knows real estate and knows those deals and what's kind of like deal or no deal type thing.
Yep.
Okay, so we got to I'm just going to call that underwrite. And you said real estate expert. You didn't necessarily say appraiser.
No, no. I mean, there's some great appraisers out there, but for the most part, they send a 200-page document and change the photos and a couple comps in there. So yeah, again, there's great appraisers out there, but there's a lot of real estate.
It could be another real estate investor, people with experience, an agent,
investor,
broker.
Yeah, a lot of times they're going to have more of a pulse on the market and really know what the true value of that property is.
Okay. Let me ask one another way. What has been the reason for Capital Fund success? Like, why have you guys, because the Phoenix market has gone up and down, but why have you guys, because you guys have been around for a while, why have you guys had such staying power? What's been the reason for your success?
I would say the main thing is we do what we say we're going to do. When we say we're going to fund a loan, the money shows up to escrow on time. Knock on wood, over 15 years, we've never, had to pull the rug out from an investor and say, oh, sorry, we don't have the money. Yeah. So really just, doing what we say we're going to do, deliver good news quick and deliver bad news quicker. If it's a deal that we don't like, we immediately tell the borrower we don't like it, or, hey, I know you wanted to put 10% down, but we're going to require 30% down. Because, unfortunately, most of the people in our industry are great people, but there's some unscrupulous folks out there like there is in any industry. And, you hear the horror stories of, borrower getting terms and then showing up to the title company, and all of a sudden the interest rates, 300 basis points higher, and, the origination fee was going to be 1 and now it's 3 because, the borrower has earnest money up and they got to close. So that's just no way to build a business or a reputation. So yeah, I would say that's kind of the main reason for our success.
Awesome. Cool. All right. Okay. No other questions?
Right, I just have a comment. I know a lot of you have asked questions, like very specific questions about how Capital Fund lends, or like, how can I invest in the fund and stuff. So like, we provide these webinars as like educational in nature.
Oh, yeah. We got some learn more though, and I'll hit a couple other things on that too.
So you can just reach out to them directly, go to their websites that we've provided, and connect with them, ask all them the questions there, and we'll just keep it at a high level here. I do have one though on here. Does Capital Fund loan on portfolios?
Yeah.
Like maybe a note portfolio, or maybe like a multifamily portfolio, or a SFR portfolio? Yeah. And how would that work?
Yeah. I mean, we definitely make loans on portfolios as long as we're lending on the real estate. So yeah, whether it's a 10, 20, 30 property single family residential portfolio, we've done some loans on a small, hotel portfolio or small multifamily portfolio, but yeah, absolutely. And typically we just create one loan that secures all the properties.
Awesome. And what is the, I don't know if we caught this earlier or not, what is typically your minimum loan amount?
Yeah, minimum, 50, 100,000. So we'll make some smaller loan amounts, especially in, markets like Texas, Tennessee, and Georgia that just have a lower.
Whoa, median. Texas, everything's bigger there. So 50,000.
Whoa, including the property taxes, which
that's one thing they don't mention with no state income tax.
Yeah, that could be like on a $2-3 million property in Texas. Your property taxes can be 50,000.
At least, yeah,
that's crazy.
Even more, yeah, absolutely.
Yeah. Well, let me just share some of the slides here. I think we shared this in the deck, and thanks for everybody for joining us. This is obviously meant to be educational in nature, doesn't constitute investment advice. But also, just here's some ways you can get in touch with Capital Fund here. You can click that QR code. We drop some of the links on the URLs. You can connect with Noah or any of his team members there. And then we have our Alt Asset Summit coming up October 24th and 25th. This is going to be here in Scottsdale, Arizona. We're doing a 9-hole golf tournament with the pitch and putt clinic before it. That's why you see the little golf course there. We might get Noah out there. We talked about having you on a panel.
Orange Tree, I'm actually working on remodeling a home on the golf.
So we'll do a site visit.
Yeah,
we'll do a
there we
tour.
go.
Yeah. You got a
Hopefully-
capital fund sign up out front?
We don't yet.
Funded by capital fund?
We probably
This project
should.
has been funded.
Yeah.
I've seen those around town.
Oh yeah.
And so, but this is going to be an amazing event. I mean, we're going to have speakers on oil and gas, on commercial, on single family real estate, on angel investing, private equity, venture capital. I'll be speaking. Mark's going to be speaking. Mark J. Kohler, Pace Morby speaking. Vina Jetty. We got a whole list of amazing speakers from all different asset classes and alternative asset investing. And so, I'm actually talked about Noah. I'm working to putting a panel together on the private debt topic in particular, is people that have private debt funds or they're typically lending out to other investors in private debt deals. It's a super interesting topic, perfect for the Alt Asset Summit. All right, well, thank you everybody for joining us. Of course, make sure you're subscribed to our newsletter. You can get subscribed to that at directira.com. We announce all of our webinars. Thank you, Noah, for being here.
Absolutely. Thanks for having me. This is fun.
Thank you, Aaron, for fielding all the questions.
Stay strong, stay hard.
Yeah, okay, and thank you everyone for being on. We'll see you next time.